Good morning. Thank you for joining us this morning. My name is Faith Ann Butcher. I'm the Chief Impact Officer here at United Way of Westchester and Putnam. United Way is an anti-poverty organization that supports education, income, and health initiatives to help residents become self-sufficient. We work to improve the lives of the 40% of our neighbors who live paycheck to paycheck or in poverty by providing strategic resources and tools to help struggling residents lead a better, more stable life. At United Way, we believe we are stronger together, and it is only by being united that we can change lives. We know we can't do it on our own. I'd like to thank Webster Bank for partnering with us today on this informative financial webinar that will discuss the importance of credit, how credit scores are calculated, and how to check your credit. Let me tell you about today's speakers. In his 14 years as a financial services professional, Craig Johnson, who's the Vice President, Bank at Work Relationship Manager at Webster Bank, has provided more than financial health to the community he serves. His financial wellness seminars with Webster Bank has enabled thousands of consumers and businesses to achieve greater profitability and financial goals. As a FINRA licensed banker, he has presented in communities all over the Northeast and has been notable for topic discussions in budgeting, credit repair, preparation for life events, business, and consumer lending. His passionate presentations resonate with participants for a phenomenal introduction and understanding to banking. Boy, is that needed today. Then also with us is Trena McNeal, the Assistant Vice President of the Banking Center at Webster Bank in Larchmont. She has been in the financial service industry for over 12 years, where she's excelled in several different positions. She's currently serving as the Assistant Vice President and Banking Center Manager at Webster Bank's Larchmont location. She's also just been deemed a United Way ambassador, so we appreciate her service. Her passion for supporting nonprofit organizations within our community has led to her nomination as a regional support champion, engagement ambassador at Bank at Work champion. She works with educational institutions, nonprofit organizations, and small businesses to provide financial literacy seminars, empowering participants in basic banking, credit management, along with consumer and business lending. Please join me in welcoming Craig Johnson and Trena McNeal.
Good morning, everyone. I hope you can all hear me well. I should say good morning, United Way, and thank you for having Ms. Trena and I to present to you today's Webster Bank's Understanding Credit Guided Virtual Experience. I should share with you all that through Bank at Work as an employee benefits program, Webster has dedicated resources investing in the communities we serve by way of financial wellness, ensuring the financial health of each individual is not only an ask of 54% of the working class population surveyed by the world's largest professional networking firm, PricewaterhouseCoopers, but it's truly paramount to the financial stability of the communities that we serve, and just one of the ways that we know we can give back. If I could just take a moment to share my screen with you all. Before we dive into today's presentation, I'd like to formally introduce myself. Thank you for that introduction, Fitz. My name is Craig Johnson, VP Bank at Work Relationship Manager and the facilitator of today's demonstration. Today's presentation is made possible by the Webster Bank Larchmont Banking Center located at 1265 Boston Post Road in Larchmont, New York, and their partnership with United Way, Westchester, Putnam County. Joining me from the Banking Center in Larchmont is Trena McNeal, Banking Center Manager Extraordinaire. Trena, please introduce yourself.
Hi, good morning, everyone. Thank you, Craig, and thank you, Faith, for that wonderful introduction. So as Faith mentioned before, I have worked with Webster Bank for over I've been in the financial business for over 12 years, and I've been at Webster Bank for over 8 years. I'm very passionate about working with organizations such as United Way, and very passionate about, empowering people to, get their basic understanding of topics like what we're going to cover today, understanding credit and understanding basic banking needs. I'm very excited to be here with you guys today. So feel free to, ask questions and give us your feedback at the end of this presentation. Thank you, Craig.
Thank you,
Back to you.
Trena. Absolutely. Before we leave this slide, I encourage everyone to note the contact information for everyone that's made today possible. And remember that we are resources to you. Feel free to use us as such. As with each of our presentations, we will pause at the end of each segment for questions, but also feel free to take notes and capture questions for a Q&A at the end of the demonstration. All right. Well, today's time together will be spent gathering an understanding of credit. We will look to highlight credit basics, the different types of credit, why it is important to manage credit in the cost of credit segment, where you can find your scores or credit reporting agencies, provide some best practices in the how your score is calculated segment, and why maintaining a healthy score is important. Today's Understanding Credit guided experience is intended for consumers or individuals like you and I, as business credit scores are managed a little differently. Before I leave this slide, I do want to share an extra special thank you to everyone, you ladies and gentlemen at the United Way, actually. Without the team there, Faith, Katie, that are truly doing phenomenal work in the communities that we serve, seeking resources to provide to the communities that we serve. Conversations like today would not happen, would not be possible. So I have to share an extra special thank you to the team at United Way, Westchester, Putnam. Well, let's jump right into credit basics. The FICO, or Fair Isaac Corporation scoring model, is the most widely used scoring model. It was first introduced in 1989 as a way to measure the likelihood that someone would pay their debts. Credit scores in this model can be as low as 300 and as high as 850. Generally speaking, when applying for credit, a good score will be between 680 and 850. Many people do strive for a perfect credit score, and while not always necessary, typically you receive more favorable credit terms when your score is higher. Credit can be useful in times of an emergency or when in need of a big purchase that may require you to borrow with loans such as a mortgage or an auto loan. It's certainly more convenient than carrying around large quantities of cash. Your usage of it can be rewarded, and it could actually even affect your ability to obtain insurance, rent or buy a home, and even obtain a job in some scenarios. Just about most financial decisions you will ever make are impacted by your credit score. And just to reiterate, the higher your score, the more likely a financial institution is to trust you and with more favorable terms. So the higher the credit score, the lower your interest rates will be, and covertly, the lower your credit score, the higher your interest rate will be, or less favorable lending terms you will receive. Someone with a history of making on-time payments to their lenders will have enabled a well-built, good credit history. A credit does come in many forms as it pertains to bank products, but typically only two forms as it's relevant to repayment. Additionally, you are generally shared what type of credit you are applying for prior to the time of application. As it pertains to repayment type, your choices are usually fixed or variable rate loans. And just as their names suggest, a fixed rate loan will have a fixed payment that will never change over the life of the loan, where a variable rate loan may change over time, impacting the payment amount. With relation to bank products and how a consumer would access the credit issued to them, the most commonly used are the following. So credit cards first, which again, I think may be the most common. These are a way for borrowers to make purchases on an ongoing basis with a revolving line of credit or something they can use, pay back, use, pay back. This tool enables borrowers to make a purchase without needing to pay for it immediately with their cash. Home loans actually possess their own subcategories of products, all with the same or the common theme that they are secured by a residential dwelling. Some of these loans are used to purchase the dwelling or use equity paid into the dwelling. Some of these options are fixed in rate, and some of them are variable in rate. For a thorough introduction to home loans, I encourage you all to attend Webster Bank's home buyers presentation with Bank at Work. Secured or collateral loans, these terms are actually used interchangeably to describe any type of loan that is secured by collateral, where if the loan is not paid back, the collateralized item will be seized by the lender. So for example, an auto loan could be a secured or collateral loan where your Porsche 911 Turbo is the collateralized item securing the loan. Unsecured loans are covertly not backed by collateral. This can be typically seen in the form of a personal loan. Credit cards too are typically unsecured. However, some banks, including Webster, offer secured credit card options as a tool to really enable someone to build credit history. In this instance, a cash deposit is typically taken and a credit card is issued for the amount of the deposit made. You are provided that credit card for which you can now use payback as a revolving line of credit, again, to establish or rebuild credit history. Credit can be an amazing tool. It can get you into your dream home or even send your child off to college. It all does come at a cost, however, and some banks may call this the cost of doing business. But for this presentation, I'd like for you to reference it as the cost of credit. And there are a few terms that I would like to get you familiar with as you consider using credit. And first is fees. Fees, these are charges a financial institution may make for an application processing or even for servicing your credit request. A servicing fee may be identified as an annual fee by a lender. Interest, this is typically defined as a percentage and is ultimately the amount of money a financial institution will charge you for allowing you to borrow. This can be fixed or variable in a defined percentage. APR, or annual percentage rate, is defined as the cost of borrowing money on an annual basis and will include the interest rate plus fees. Minimum payment, or paying the minimum, is the required remittance to reimburse the financial institution for the credit issued. In most instances, borrowers will find that paying the minimum is not the most cost-effective way to borrow. In the scenario that you're seeing on screen, we have a borrower that has used $10,000 worth of issued credit at 15% APR with a minimum payment of 4%. With the borrower paying the minimum payment of $400, in this scenario, it takes the borrower 12 years and 4 months, paying close to $4,500, almost half of what they originally borrowed, where if that same borrower had added an additional $250 to their payment monthly, the credit issued is repaid in 15 months with nearly a fifth of the interest charged in comparison. And that's what you're seeing in these two scenarios on screen. A credit reporting agency or credit bureau is a data collection agency. They gather account information from various creditors and provide that information in a consumer report that includes bankruptcy filings, court order judgment, tax liens, and how well you have maintained your credit worthiness. These agencies will also assign your report a score based on the information reported. The three major credit reporting agencies in the US are Equifax, Experian, and TransUnion. Information that they will retain includes, but is not limited to, your name, social security number, date of birth, any address you may have resided at, telephone numbers, number of inquiries made to your score and by who, how well you've managed your credit, and any public records. Financial institutions, insurance company, landlords, and employers are all channels you can expect may want to view your credit report. Maybe we should pause there to see if there are any questions at this time. All right, easy enough. I think we'll certainly get some questions after this particular segment. How your credit score is calculated may be the most important question we answer for you today. I'll also mention some best practices in each line item as we review. Repayment history is the largest contributing factor to your credit score at 35%. It is imperative to pay your creditors on time. A late payment can drop your score significantly. This is especially true for borrowers with a limited credit history. While minimum payments are not ideal in the repayment of credit, if your lender allows for auto pay, it is certainly a fantastic option to ensure that at the very least, your minimum payment is always made and always made on time. Apps like Smart Wallet or even calendar reminders are simple tools that could also guarantee that you don't miss a beat where your payments are concerned. Amount owed is the second largest contributing factor at 30%. The credit reporting agencies will add the amount reported owed by your lenders and compare that to your limits. The lower your balances in comparison to your limits, the more responsible you seem with credit usage. A rule of thumb here with regard to revolving credit, keep your balances at less than a third for optimum credit reporting. So for example, if your credit limit total is $9,000, keep your balances to less than $3,000 for optimum credit reporting. At 15%, credit history does play a role. The longer that you've managed credit, the better. An account that you have had open for 10 years will have a greater impact to your score for one that you have had open for 10 months. And this is simply because of the time that you've spent making on-time payments to the creditor that you've had for a much longer time.
Craig?
Yes.
I think we have a question in the chat. We have a question from Sabrina. Do you want us to answer those questions?
Let's take that question, Ms. Trena.
So Sabrina is asking, what is the difference between a hard and a soft inquiry? Who should I allow to check? Who should I allow to know or check my official credit score? Do you want to take that one, Craig?
Yeah,
Or?
absolutely. So the first part of that question was, what is the difference between a hard and soft inquiry? It is important to know that both of these are inquiries to your credit report. Soft inquiries will not obtain as much information as a hard inquiry will to your credit, or for your credit report, rather, I should share. A hard inquiry will contain a lot of detailed information about your creditors and how you've managed using your credit report. They are both, however, inquiries to your credit report, and both will look as such. So if a creditor or lender, I should say, is looking to make an inquiry to your score and they share with you that we're going to be making a soft inquiry, a soft inquiry will have an impact to your score, much like how a hard inquiry will have to your score. So I think it's important to know that primarily the difference between the two is the information that that lender will receive or that creditor will receive as a result of making the inquiry. As it pertains to who you should allow to make inquiries to your credit report, the only people that you would want to allow, or the only institutions that you would want to allow to make credit inquiries to your score, are persons that you have specific reasons to give permission to. So I know I shared a little bit previously about landlords, insurance companies, employers, and then creditors. These are all people or institutions that you could anticipate may want to make inquiries to your credit based on whatever inquiry reasons that you've essentially enabled them to make. Landlords specifically, if you're looking to rent from that particular landlord, they have the need to make a credit inquiry because they want to see that you've paid your bills on time. And so in that scenario, you may want to allow that landlord to make an inquiry. A creditor, very similarly, if you are looking to borrow on a mortgage, it's really whom you've enabled permission to. That's who you want to allow make credit inquiries to your score. Anyone that you probably have a business reason to make an inquiry to your score are people or institutions that you want to allow to make credit inquiries.
Sabrina, I hope that answers your question. Craig, we did have another question. The question is, how do we establish business credit for a small business without using your own personal line of credit?
That is a fantastic question. And I would share with you that you really want to work with your banker to get your business credit off the floor. Your banker should be able to introduce you to resources locally that are typically free of charge to enable businesses to get off the ground. A lot of these like institutions would probably identify themselves as business startup services, and they are typically located, believe it or not, at community colleges. Lehman College in the Bronx. I know for Westchester specifically, we do have resources at PACE where they are free of charge, enabling you to say, let's put together what is projections, let's put together what is a business plan, and let's work on establishing your business credit. There is an entirely different presentation that we present around business credit and how to establish that. There is an entirely different reporting agency that reports business credit, and the scores are actually calculated a little differently as well. I encourage you all, especially if you are looking to build business credit, connect with your banker. Again, I know I mentioned, capturing Ms. Trena's and my information at the beginning of the presentation. I'll make sure to share that again at the end of the presentation, because resources like Trena that are in our communities are really invaluable, I think, to getting businesses off the ground and up and running. If I could mention an additional resource there, the small business development centers that we have resources to, or that we have personnel working at that are free, again, free resources to the communities that they serve. Those SBDCs, you can actually just Google the nearest SBDC to you. And again, these are resources that are extended to the communities that we serve. They receive government funding to make sure that, businesses, small businesses in our communities get up and running. Connect with one nearest to you if you don't have an opportunity to connect with a banker like Ms. Trena or myself.
Craig, I don't know if you wanted to get into it, but I know it is a very important question, establishing business credit. But oftentimes I feel like it all depends on what you're doing, because if you're a guarantor on a loan, it does require you to kind of do an inquiry on your personal credit as well, because you're guaranteeing the loan. So there is more to it, but as Craig mentioned, you definitely want to partner with your banker to, so the banker you guys can work out a plan, because it all comes down to what your ultimate goal is and what you're looking to do. Yeah,
that's a great sentiment to share, Ms. Trena. When you are a business owner and you're applying for credit for a business, a bank may want to see that you have some skin in the game. And what does that mean? That really means backing your business plan, particularly if you are a guarantor on it. If you don't trust in your business plan, a bank or financial institution may feel, why should we? So yes, different scenarios may call on you to be a guarantor on your business loans and lines of credit request. Again, I encourage you all to attend our business credit presentation. We actually go into a little bit about how Dun & Bradstreet report business credit scores. That's actually their credit reporting agency. So for consumers, it's Equifax, Experian, and TransUnion. For businesses, the most commonly used is Dun & Bradstreet, or D&B, some people may refer to it as. Good questions there. Any others from the chat, Ms. Trena?
That was it for now. They did wanted to know if, Webster Bank offers some of these services, and I did respond to that. But that was it for now. Thank you, Craig.
Thank you. Well, moving right along, variations in credit used is counted towards your personal credit score at 10%. This is, do you use credit cards? Do you use an auto loan, a personal loan, a mortgage, etc.? Lenders want to see where you borrow from and if you can manage different types of credit. Because everyone's borrowing needs are different where types of credit used is concerned, everyone is a little unique. As it relates to new credit, it's important to know that lenders may feel as though you are in financial trouble if you have many inquiries in a short span of time. Multiple inquiries will cause your score to drop, regardless to whether they are soft or hard inquiries. It is also important to know that the exception to this is when shopping for a mortgage or auto loan. The credit bureaus know that these items are larger purchases and the consumer may look at multiple lenders for the best rate possible. Any like inquiries within a 30-day time span in these categories will actually count as one inquiry. to your credit score. I'd like to take a moment now to put a dollar value on your credit by providing insight to how your score affects the credit issued and how it is repaid. In the example that you're seeing on screen, I'm providing you with two different consumers. They are both looking to borrow $150,000 with a fixed rate loan at a term of 30 years, which is pretty common for mortgages. The first consumer has done well to maintain their credit score and has a 730. Because of this, in the rate chart here, they will receive favorable lending terms with the lowest rate possible. And in this example, I'm sharing a 5.526%, making their monthly payment $854. The second consumer has neglected to maintain their credit score, and because of this has a 670 with a payment of $1,032, paying $178 more towards interest monthly, or $64,080 more towards interest over the life of the loan. The higher the score, the more likely you are to be approved, and your score could even dictate how much home you can afford. I like to share in this particular segment that a good score pays for itself in dollars saved. The road to good credit is a disciplined trail. Consistency will be key, but you can't get to where you're going unless you know where you are. So first things first, check your credit report. You can do this annually, free of charge, at annualcreditreport.com. It is best practice to do this at the very least on an annual basis. So much like how you visit a doctor annually for your physical health, check your credit report annually for your credit's health. I normally share just the best practice around remembering to do this. Do it every time you file your taxes. This is also a great deterrent for identity theft and accuracy in reporting errors. Many people do use applications like Credit Karma to monitor their credit usage and reporting more frequently. And while the score on creditkarma.com may not be exact, this is still a great tool to monitor usage and how it can impact your score. Dispute errors on your credit report with the credit reporting agencies, and do so directly. Each of the bureaus has a process outlined on their website for how to engage this. So all three of them have a process on their website how to engage this. This process is also detailed when you request your credit report from annualcreditreport.com. And then I think it's always important to ensure you follow up with each bureau after a request has been made. It does typically take around 30 to 45 days to enable processing for a request to remove an item from a credit report. And you want to follow up with those bureaus to make sure that they have done just that. I don't think it's ever too late to begin the journey to better credit or credit repair. Mine began not that long ago at a very similar presentation to the one that we're having today. It was followed with a phone call to Experian Credit Educator 9 years ago. Wow. Where I spent a scheduled hour over the phone to correct inconsistencies on my report, and just a little bit more on that Experian Credit Educator to share a little bit about my experience 9 years ago. What Experian Credit Educator does, or what it enables, is really a conversation that's scheduled to happen with a consumer over the line. So what Experian will do is give you a representative over the line where you're spending a scheduled hour with a representative going through every line item on your credit report, your spelling of your name, addresses that you've resided at, any inquiries that have been made to your credit report, soft or hard, They'll look at accounts that have been filed, charged off. If accounts are over 7 years old and they should be removed from your credit report, they'll take some time to do that with you as well. It's super important to have, who better than the actual credit reporting agency to connect with about your individual credit report. I thought the most eye-opening thing about this particular experience was at the end of our session where we really went through every item on our credit report, on my credit report, and allowed me to see it on screen with them. I thought the most eye-opening part about this experience was at the end of our time together, Experian ran three scenarios for me that they thought would impact my score the greatest, or that they knew rather would impact my score the greatest. And I thought to myself at the time, I had been maintaining this like 690, stagnant 690 credit score. I couldn't break into the 700s. And I thought to myself, wow, you're doing everything right. Like, why hasn't it broken into the 700s? Pay all my bills on time. I pay more than the minimum balance. Everything's kind of scheduled auto pay. I maintain everything at a third. Why haven't I broken into the 700s? And the gentleman that I was working with on the line shared with me, Craig, I can see your payment history on your credit report. You're doing a great job at maintaining it. You're doing all the right things in terms of rules of thumb. Instead of paying that $1,000 that you pay towards your credit cards every month, take $1,000 next month and pay it towards your auto loan. You're going to see a 46-point increase in your credit score. And I thought to myself, well, why is that a thing? Like, I don't understand. And the gentleman shared over the line, it's just simply because of where you are with your auto loan currently. If you pay the $1,000 to it, you will see that 46-point increase. So instead of paying that towards your credit cards this month, pay it towards your auto loan. And he ran two other scenarios for me that would also increase my score, but this was the highest one. There was a 46-point, I believe it was a 29-point, and then a 15-point scenario that he ran for me. And I thought to myself, you know what, try it. I don't know why it would make sense to do this, or why it would make sense for your score to increase just as a result of paying this towards your auto loan, but do it. I did it, and I'll remember the day like it was yesterday. I was sitting at my desk. I got an alert from my creditkarma.com app that said, your score has changed. And I thought to myself, well, what happened? And I went in and I checked, and my score had increased 46 points. I wanted to throw a party. I thought to myself, this gentleman was the best thing that happened since sliced bread. And I quickly followed up that particular practice that he shared, or that particular scenario that he shared for me, with the additional two to get really to optimum credit report or optimum credit score for what was my particular scenario. Everyone is different where credit reporting is concerned. So just to share a little bit about my experience with that particular Experian Credit Educator, fantastic tool. You can visit or schedule an appointment with them at Experian.com. They do enable virtual presentations. You don't have to physically go anywhere, and they'll schedule that hour for you when it's best. And I believe they actually run from 7 a.m. to 7 p.m. with that particular credit educator. From this, I really got a better understanding of me, my personal scenario, and knowing and learning that everybody's credit is going to be a little different from person to person. There are fantastic rules of thumbs. I've shared them. I shared a lot of them with you today, but each individual does have a unique scenario. So from debt reduction to home purchasing, there are hundreds of reasons and goals to why understanding credit is important. And today is your first step, I believe. All right. Well, United Way, Westchester, Putnam, I'd love to open the line now. I'd love to open the chat to any inquiries. Ms. Trena, if you want to share them with me, I'm happy to take inquiries now in our Q&A.
No questions so far in the chat, Craig, but I can say I got an email already from someone who has a situation going on and needs some help. So that's great.
Yeah, I would share our contact information again, ladies and gentlemen. Feel free to use us as resources. That's again what we're here for. Community has and always will be that something that Webster holds near and dear. It's in our values. Again, it will always be. And I think the financial stability of each individual is really paramount to the success of our communities, the financial success of our communities. And it's just one of the ways that we know we can give back. So we're happy to do so.
Craig, we do have a question in the chat from Matt. Matt is asking, are certain credit card rewards truly better than others? For example, should I consider a credit card that has cashback rewards over one that guarantees free hairline miles?
Yeah. So great question, Matt. And I will share with you that do I think all rewards programs are equal on credit cards? I do not believe so. I believe there are specific credit cards that do offer a better reward based on your particular scenario. If you know that you're constantly at a grocery store, you love to cook at home, you don't go out to eat, maybe one that offers you more cash back or more rewards points are on in-store purchases at grocery stores, maybe that particular credit card is better for you. But if you know that you are, a travel, bug, you got the bug and you're constantly, on the go, out of the country or out of the state, visiting family or just taking vacation, maybe one that offers more towards travel rewards or points is better suited for you. So I don't believe all reward programs are created equally with the credit cards. But I certainly think it's on a case-by-case scenario, depending on what you typically spend your funds on. And I'll share with you, some credit cards actually kind of break that down for you, what you typically, are spending your funds on. If it's gasoline, if it's groceries, if it's entertainment. Some credit cards actually offer you the ability to kind of see that, on a monthly basis. So food for thought while you're considering a credit card and rewards. First, I always share, look for one that will reward your usage, but certainly take the time to kind of think about what those rewards are and how you can use them in your day-to-day.
Yeah, and just to add on Craig's comments, one thing you want to make sure, you want to really inquire about how you can redeem your rewards, because credit cards rewards are different in terms of how you can redeem them. Some credit cards rewards will allow you to redeem for mileage, for cashback, towards statement credit. So you want to, inquire how you can redeem those rewards. Craig, we have another question. This question says, should I switch from my debit card to credit if I keep my spending habits the same, even if I am not paying? Oops, sorry. It's kind of scrolled there. Hold on. Even if I'm not paying on everything larger than groceries or rent.
So great question. I think credit usage, right, as it pertains to on a monthly basis, if you're swapping from using your debit card to credit card, is really a neat way to kind of show that you're really good at managing your credit, but you want to be careful in that credit cards charge interest, right? So, for your budgetary needs, does it make sense for you to put everything on your credit card? You should consider that prior to making that switch. So what does that mean? If your credit card is charging you, let's just give an example, 29% in interest, and you're, spending $100 in groceries on a monthly basis, can you or do you want to pay $129 for that particular purchase versus paying the $100 to it? Or is there a cutoff date where if you make the payment to it, that you're not getting charged interest? Or is there an introductory period where you're using your credit card at a 0% so that you're not getting charged interest? These are things that you want to consider before swapping your spending monthly onto a credit card. I do believe that some people find value in doing that. One, because of the credit history that you're building, it looks like you're managing your credit very well, but also based on the reward points or cash back that you may be getting from those particular purchases. So in this scenario, it's important to consider those line items, your budget, any reward points or cash back that you're getting for spending on your credit cards. Some people do see value in it, swapping their spending to their credit cards, but it's really on a case-by-case scenario. Consider those things before deciding, swapping to spending on your credit card versus your debit.
Yeah, I think you covered everything there, Craig, including usage as well. You want to make sure, depending on what that monthly amount is, if it's putting your usage at over that 30%, I like to keep my usage under 10%. So if that monthly swipe on your credit card is going to keep your usage over 30%, I don't think it helps you in terms of credit building. But great points, Craig. That's awesome. So we have another question. This question said, is consolidating debit a good option for someone who has maybe taken on too much debt? Would this help lower the amount of money one pays back in interest?
So another good question, and I'll share with you that debt consolidation, more often than not, is beneficial for someone to consider if they feel as though they've taken on too much debt. So what do I mean by in most scenarios or more often than not? So in most scenarios, you would be consolidating what would be let's just give an example of, 3 credit cards that are maxed out at $3,000 each. That's $9,000 total. And let's say that one of the credit cards was at 29%, one was at 26%, and the other was at 21%. You're obviously, making your on-time payments, but you're not seeing your balance move, so you may consider debt consolidation. In these scenarios, typically someone may consider using a home equity loan or line of credit to consolidate their debt, or an unsecured personal loan to consolidate their debt. In this scenario, let's just say we're using an unsecured personal loan. That personal loan may have an interest rate of 5 or 6%, in which scenario all of your credit cards are being paid off and you're paying now one payment at 5 or 6% to that personal loan that is termed for 5 years. In that scenario, I think everyone could kind of see the win there. There's, from going from a 29, 26, and 21% to going to, 5 or 6%, where it's termed. In that scenario, you're kind of winning, or you are winning. You've consolidated your debt. You don't have to worry about making those 3 different payments. Now you're making one payment at a much lower interest rate. So you're paying less towards interest, and you're probably feeling, a little bit of breathing room. In the scenario where you may not, or it may not seem like you're winning, is if you happen to take on a loan where the interest rate is, let's say, 30%. You're taking on a personal loan where you're consolidating all 3 debts, where it kind of looks like, hey, I'm paying off all of my debts. But in reality, if you're paying more towards interest, you're going to be paying more towards that loan. So does that make sense for you? In that scenario, some people or an individual may say, wow, or look back at it and think, I'm paying more towards interest than I was on those 3 different credit cards, even though they are paid off. The other line item to consider is once you've consolidated those debts, and I think just as a best practice with debt consolidation, you have to be honest with yourself. Are you going to be using those credit cards again after you've consolidated those debts? I think being honest with yourself, being disciplined, to say, I'm not going to use these credit cards after I've, consolidated this debt, or I'm going to restrict usage to, only this amount because I know I can pay it off on a monthly basis. Those are line items to consider, I think, when you're talking debt consolidation. But I will share with you that generally speaking, it's a fantastic win if you feel like you've taken on too much debt.
Thank you, Craig. I hope that answers the question. We have another question. It says, will closing or canceling a credit card in good standing affect your credit? I know that's a very popular question we get all the time.
It is a very popular question. And I know I shared back on one of the slides that a credit card that you've had open for 10 years will have a greater impact on one that you've had open for 10 months. This is particularly true when you're saying, I want to close an account, even though it's in good standing. That account will no longer report to your credit bureaus. So the account that you've had open for 120 months that you've made on-time payments to won't be reported anymore to the credit reporting agency. So you can expect that your score may drop if you close an account that you've had open and in good standing. But if you don't find value in having that account open, so let's say that you're paying, a $250 annual fee on that account, but you're not using it annually, or you're not taking advantage of, the reward points on that because you have another card that's giving you better benefits, it may be advantageous of you to consider closing it, for your budgetary needs. So in that scenario, the hit to your score or the decrease in your score may seem of value, so that way you can actually manage what is your cash flow on a monthly basis or on an annual basis. So yes, it will impact your score if you happen to close it. I should share that with the group. But it may be advantageous of you to consider, especially, if you're not using that account, or if on an annual basis you're being charged for that particular account, but not necessarily finding value in having it open.
Yeah. We have another question, Craig. Question is, will removing credit that is more than 7 years old overall help your credit for possible future loans?
So, Ms. Trena, in this scenario, it really depends on if it is being reported as a good credit history, or if it's something that may have been charged off in the past. In most scenarios, we're talking about things that have been charged off in the past. So if someone, let's say, opened a credit card 6 years ago, it was charged off, reporting a balance owed on it that was never paid, that's going to impact your score negatively, right? Until that line item is either paid off, and even in that scenario, it's actually still being reported as negatively. But it won't be reported as, or it won't be removed from your credit score until that 7-year mark. And so the 7th year now comes upon you. You want to seek to have it removed from your credit report because the 7th year has lapsed. In that scenario, you should always see a positive impact to your credit score. And so typically when we're talking about that 7-year mark and having line items removed from your credit report, we're typically talking about credit that has been reported negatively. So to have it removed from your report will actually positively impact your score. And you should see that again, typically at the 7th year mark. If it hasn't fallen off by itself, take the time to report that to the credit reporting agencies, all three. In fact, you don't want to just report to one. You want to ask all three if they've removed it.
Yeah, I actually want to share something that happened to me recently. So I saw a dip with my credit, just a few points, nothing significant. I was still in over the benchmark with fairly great credit, but I did notice that I had an auto loan that came off. And I called that lender and actually asked them to put that credit back on, report that loan back on my credit, and they agreed. So that's something that you can do. And I learned that for the first time, but it all depends on the creditor. most creditors will not do that, but it's something to consider. So with that said, if it's impacting you positively and it's being removed after the 7th year, you definitely can ask the lender to put it back on your credit. In some cases they will, most cases they will not. But obviously, as Craig mentioned, if it's something that is impacting you negatively and it's coming off in that 7th year, hey, that's good for you. You don't want to have that on your credit. But great question, and I hope that we were able to answer that question for you. And then we have one more question. Question is, aside from applying for a personal loan with a low interest rate for consolidating debt, can someone negotiate their credit card's APR interest rate to be lowered when the person has a low credit score?
So in this scenario, I would share with you, it really depends on your financial institution, depending on their guidelines. A financial institution that manages their credit cards, that says, we have the capability of kind of dropping the rate for our good customers or for our customers in general. That's on a financial institution case-by-case scenario. I've seen scenarios where someone may be able to negotiate dropping their interest rate on a particular account because they've had it open for an extended period of time, and that particular financial institution is okay to work with them on their credit card accounts. But I will share with you that we don't typically see it. It's not a typical practice for a financial institution to say, hey, we'll lower your interest rate because you're making the inquiry to us and because you've been a good client. Most financial institutions may share, hey, these were the terms that you agreed to at the time of application. So food for thought. Even while you're applying for credit cards, do these kind of things happen at the financial institution that you're working with?
Awesome. Craig, so we do have one last question, and given the time, hopefully we'll squeeze this one in. This question is, person looking to obtain their first car, what would be a better choice to finance? What would be a better choice, finance or lease?
So in this particular scenario, Ms. Trena, again, I think financing or leasing is really based on your lifestyle, how you typically use your vehicle specifically. If you are, the type of person that wants a new car, every 2 years, or don't want to keep up with maintenance, or don't drive a lot, and particularly, or use your car to, kind of travel or do road trips, then leasing may be better for you. If you're looking to, to customize your vehicle, or you foresee yourself taking cross-country road trips on a monthly basis, where you're going to be putting a lot of miles on your vehicle, different lease agreements, will have a specific amount of miles or term rather, and you have to stay within that, or if not, you typically get charged for going outside of that. In that scenario, it may make sense for someone to finance. I particularly know that I'm a car person, so for me, I like, customizing my vehicle. I like doing road trips. Driving is kind of therapeutic for me. So for me, financing made, more sense. It didn't make sense to lease because I know at some point or another I would probably be going over the mileage allotted to me. So really, that's on a lifestyle scenario kind of basis. So consider those things, I think, when you're looking to lease or buy or finance, excuse me.
Thank you, Craig.
You're most welcome. With respect to time, I do want to give the call back to United Way, Westchester, Putnam. Before I do, I know I passed over this screen. This is attached in the presentation. These are some of our Bank at Work benefits if your employer is enrolled with Bank at Work. So I wanted to make sure that everybody kind of had that top of mind as well with the presentation that has been shared. But United Way, Westchester, Putnam, it's been fantastic connecting with you all today. These questions were great. I hope you all took something away from our presentation today. Most importantly, remember that Trena and myself, we're happy to be resources for you in the community.
I'm going to just hop on for 1 second. I'm going to try to be cognizant of the time, but we had so many great questions going. I didn't want to cut anyone off. But just a huge thank you to Craig and Trena for this great presentation and your time and your insights into credit. It was really wonderful. Thank you so much. We're so thrilled at United Way of Westchester and Putnam to have this great partnership and relationship with Webster Bank. And we look forward to working with you guys on future initiatives. And huge thank you to our audience for being so engaging and having so many great questions.
All right. Yeah, I would say so. Thank you, audience.
Great. I hope everyone has a great day. And if you have any questions, I hope you got down Trena and Craig's information. And you can also follow up with us at United Way. Feel free.
Thank you, guys.
Yes, thank you all.
Thank you so much, Craig.
Perfect. Thanks, everyone.
Enjoy the day.